Welcome to Retire Right with Rick Durkee, presented exclusively by the Coastal Financial Planning Group here on News Radio 94.3 WSC. Rick Durkee is the retirement income planning and wealth distribution specialist in the Lowcountry. Are you ready to retire right? Here's your host this morning, Shane Griffin.
And good morning and welcome back to Retire Right with Rick Durkee. I'm not Shane Griffin this morning as he usually intros the show, but as we change the format a little bit for the show this year, we like to have a guest every now and then on Retire Right, and typically that's the first weekend of the month. And with me this morning is a longtime friend and business associate, a financial professional here in the community that is specialized in mortgages and especially in the area of reverse mortgages, Jerry Garner with Town Bank Mortgage. Good morning, Jerry. Glad to have you on Retire Right.
Good morning, Rick. Glad to be here.
Well, Jerry, over the years, you and I have had this discussion many times about using proper cash flow planning in retirement, also income planning and tax planning with the tools that are available to us to use for sources for retirement income. The reverse mortgage certainly has become of late here a hot topic for this type of planning, and we keep on hearing this term of the new reverse mortgage. Can you share with our listener today what makes the new reverse mortgage so new?
Sure. Great question. Taking a step back for a minute, the actual reverse mortgage, as we know it today, it can also be called a home equity conversion mortgage. It was created by the Federal Housing Authority, the government, back in 1989. So many of our listeners probably are unaware that this program has been around for more than 25 years. And with the aging of America, the demographics, we have somewhere in the ballpark of about 10,000 baby boomers a day planning for retirement or actually retiring. And one of the largest assets that they have is their home, that asset being equity. And so with this wave of baby boomers retiring, inquiring, looking into the reverse mortgage, the federal government stepped in and made some sweeping changes in 2014 and 2015. So these changes are relatively new, the last 2 years. The biggest one is what we call financial assessment. From 1989 up until 2015, to qualify for the reverse mortgage, we really didn't look closely at the homeowner, the customer's income, assets, or their credit. Reverse mortgages do not require a monthly payment by the homeowner. So why do we need to look at income and assets and credit? There's no payment requirement. Well, the reason why we need to is because the homeowner is still responsible for paying their property taxes and their homeowner's insurance. And with this wave of baby boomers and retirees now taking out the reverse mortgage, we want to make sure that they have a history of paying their bills. Mm-hmm. So we do now look at credit. And we also are gathering their income. Maybe we get a copy of their Social Security award letter, their financial pension statement. We are now collecting financial statements from their IRAs, their 401ks, just verifying that they have the income and assets and the credit history to live in that house and keep those taxes and insurance paid. So there is a qualifying process now. And so what that's actually doing, Rick, it's driving our client. I don't know if affluent's the right word, but that's what I'm using here. It's more of affluent or a mass affluent. My typical client now has somewhere between $500,000 and $1.5 million in assets. Mm-hmm. And that is a big change from where the program has come from.
Right. Before it was a loan of last resort, so to speak, and now it's a planning loan.
Well, I hope we have some time this morning to talk about that, because that's a term that's been used, a loan of last resort, and that's probably the worst way to use the reverse mortgage. You want to avoid spending down all your assets and then say, well, I guess I'll take out a reverse mortgage. Mm-hmm. That's not a good strategy. We need to look at accessing equity via the reverse mortgage earlier in the process.
Yeah, I'll share a quick example with you, Jerry. I had a couple that came in to see us a few weeks back, and they had adequate assets to retire, and everything looked really good. And then I brought up the subject of, well, you still have a mortgage on the home. And they said, yeah, we do. And I said, what if you didn't have to make that mortgage payment anymore? Would that help your cash flow? And if you didn't have to make that mortgage payment anymore, maybe we could let some other assets grow that were being cashed out to pay that mortgage payment. And they said, well, how would we do that? And I said, it would be called a reverse mortgage. And they said, we never thought that might work in our situation. And these were those affluent, mass affluent people that had saved very well and had around $1 million of investable assets to retire with. They didn't have to do this loan, but all of a sudden it makes good sense for them to use that equity in the home, especially when it's tax advantaged. It's not taxed.
Knowledge is power, and it's interesting that client that you just referenced, because many times, and I'm sure you've brought up the term reverse mortgage, and the client kind of gives you this frown, like, really? Mm-hmm. When you investigate and explore all types of mortgages, including the reverse mortgage, what you'll find, it's not the product, it's not the reverse mortgage, it's some of the poor decisions or the poor uses of the funds from the reverse mortgage. I'll compare it to if you go to the ATM machine and you take out $100 and you go gamble it away. It's not the ATM machine.
That's right. That's right.
It's the decision to gamble it away. Well, it's not the reverse mortgage, because what the reverse mortgage does, it is allowing you to take a illiquid asset, equity, and we're making it liquid. Mm-hmm. And I'm thinking this is a great thing, but some people are like, wait a minute. You mean now this allows me to spend my equity? Well, how disciplined are you?
Yeah.
I mean, you need to, just like any other type of financial product, is it right for everyone? No. But it is a very powerful tool, especially when you look at some of the tax advantages, because when you spend down equity from a home, it's not taxable income. It's tax-free compared to spending down some other assets that could be taxable. So there's some advantages there also.
Right. Okay. Well, Jerry, are there any special new requirements or guidelines then that we need to discuss with our listener this morning?
I mentioned the financial assessment. So we're going to be talking about income and assets and credit. But there's also a safety feature that's built into it that you used to be able to waive this, but now you can't. All reverse mortgage customers must speak with an independent third-party reverse mortgage counselor. Just making sure somebody other than the banker, me, can answer any questions for you, your family, your advisors. Mm-hmm. So that third-party counseling is something that we help facilitate. We'll give you a list of people to call, and you can do it over the phone.
Yeah, and I know you and myself, working over the years with our clients at the Coastal Financial Planning Group, we almost had like a 3-step process. Number one, I mentioned, could this be a useful tool in your retirement income plan? So we go through our planning standpoint. Then secondly, I refer them to you, and then you go through your process. And so now there's this third person that's also involved. And then we circle the horses, you and I, and say, okay, this is how it all integrates into the plan with our clients. And you know, everybody's a winner. I mean, plenty of information is discovered during that process, 3 different sources, and then we wrap it all up with a group, discussion as to, yes, Jerry, this accomplishes the goals that our clients brought up originally, so that we can have their money do what they want and need it to do throughout the remainder of their lives and beyond.
And you referenced earlier the client that could use the reverse mortgage to eliminate their traditional mortgage payment. And since 1992, the number of homeowners over the age of 65 that are carrying mortgage debt has more than doubled. Okay. So,
all right. This is because of relocations, maybe because of refinances, because of
the home equity lines of credit, traditional home equity lines of credit.
Yep.
People are going that route and using it to remodel, using it to pay for college, using it to pay for weddings. They are refinancing and cashing out. And those are all traditional good ways to borrow money. But the concern is when you're over the age of 65, typically you're on fixed incomes. And someone told me yesterday, a retiree said another word for retirement is unemployed. So if you're on fixed incomes and you have this mortgage payment, and now you've gone out and taken out a traditional home equity line of credit, and now you have a second mortgage payment, that could put you in a bind. That can start causing you to spend down your assets quicker than you need to, or maybe you may be forced to sell the house. So One of the most popular uses of the reverse mortgage, and I'm passionate about this, you have to be age 62 or older to qualify for a reverse mortgage, age 62 or above. So anybody listening, whether you're age 62 or above, or you have parents over the age of 62, if they are still making a mortgage payment, please take the time to look into how the reverse mortgage works and if it can play a role in their financial plan by eliminating that mortgage payment, which would increase their cash flow.
And I know, Jerry, because we've had several discussions about this. Actually, I'll share this with our listeners. My parents recently used your program for a reverse mortgage, and I thank you for your help in their retirement income planning. And folks, they're not using it right now. They just wanted to have it set up because of the current conditions right now in the marketplace. And Jerry, I know you brought a couple of articles with you today, and I think you have some important information, some factoids, so to speak, that you'd like to share with our listener today regarding those articles.
With the recent changes over the last 24 to 48 months, there's been a rise in positive news stories from major publications talking about the use of the reverse mortgage. And one recent, and you can Google this and you can look it up, it's the Wall Street Journal has an article. It was published March 20th, so a couple of weeks ago. And it talks about some financial advisors are now recommending that their clients use the reverse mortgage as a part of their retirement planning.
What was the title of the article?
It's some financial advisors recommend that homeowners establish a line of credit using a federally insured reverse mortgage.
Okay, nobody's going to remember that, so just Google Wall Street Journal, some financial advisors, and the article will probably come up.
March 20th, the Wall Street Journal, and it starts, the first sentence says, and I quote, "The reverse mortgage has won some new respect." Mm-hmm. And similar to how we worked with your parents, Rick, the way to have access to equity, even if you don't quote-unquote need it right now, is use the reverse mortgage line of credit. So as an example, I have a house here in Mount Pleasant. It's worth $600,000. I owe zero on it. And I've got $500, $600, maybe $1 million over here in IRAs. But what we're doing is we're opening up reverse mortgage lines of credit, which makes a portion of that $600,000 in equity liquid, and it sits in an account, a line of credit. And reverse mortgage lines of credit, there are two very unique features. Number one is we can't close them. Mm-hmm. So if we have another recession or a downturn in the housing market, we have to guarantee that money will always be available. And secondly, there is a guaranteed growth rate. So the money that you have access to grows. So more and more money is available. Some clients use this as a hedge against a potential depreciating asset.
Yes. Yeah, so because real estate markets go up and they go down, don't they? Especially over a retirement lifespan.
Well, I'm sure we have listeners that purchased their home here in the Tri-County area in the Low Country in 2003, 2004, 2005. They know what they paid for it, and then in 2009, 2010, they were shocked what appraisers or realtors will tell them it's worth. It dropped in value. Mm-hmm. So if you have a reverse mortgage line of credit, that money that's available continues to grow, providing greater borrowing power no matter what happens to the value of your home.
Yeah, now I know you've shared with me personally because I worked through this with my parents, but also there's an interest rate decision here. With interest rates being as historically low as they are, the availability of what's afforded in the line of credit could reduce in the future if the interest rates go up. And that's another article, I guess, that you want to reference that you brought today.
Yes, Forbes, the retirement section, that's Forbes, and this article is dated March 10th of 2016. It's written by Professor Wade Fall. He's a professor of the American College. He's also a doctorate of economics at Princeton University.
Yeah, we've used Wade's information for a lot of retirement income planning on withdrawal rates and things like that.
Yes.
Professor Fall.
Professor. And it's titled, What You Need to Know About Repaying a Reverse Mortgage. And that's one area that is also a benefit, is that the flexibility of repayment. I can't recall where I heard this or read this, but it talked about financial planning, retirement planning, income planning, and it said we have to be lucky. And I kind of turned my head, lucky, and he said, well, really, it's all about luck. LUC, liquidity, use, and control. Mm-hmm. You need to have liquidity. You need to be able to use your money, and you need to be in control. And how I relate that to the use of the reverse mortgage is we're making equity liquid. You can use it however you need, and you're in control. And specifically, when you take out a reverse mortgage, yes, it's a mortgage. Yes, there's an interest rate. And one of the advantages today, if you're considering a reverse mortgage, the amount of money that is available to you is based on interest rates. The lower the rate, the more your borrowing power. So why not take out a reverse mortgage today?
The line of credit.
The line of credit, let the money set aside. Because of the low interest rate today, you're going to have access to more money up front. And if interest rates, or when interest rates start raising or rising, that growth in the line of credit also is greater. And you can call me at 843-670-4332. All I need is the estimated value of your home, your dates of birth, and I can prepare a custom proposal and show you an amortization schedule on this line of credit feature.
Okay. Jerry, we talked about an example of somebody that has an existing mortgage. Would you like to spend a little bit more time on those listeners that might have the existing mortgage already that they might want it paid off?
More than 60% of the reverse mortgages that have been taken out or used, the purpose is to eliminate a traditional mortgage. I had a closing yesterday. The home was in West Ashley. It was valued at $315,000. They owed right at $145,000, and they were making a $900 monthly payment. They simply refinanced into the reverse mortgage. They maintained ownership and control of the house. Many shows ago, we talked about some of the misconceptions. And when you take out a reverse mortgage, the bank does not take title to the house. The homeowner maintains title and control. So they simply refinanced into the reverse mortgage, paid off that existing or traditional mortgage, and now they're saving $900 a month.
It's a great example, Jerry. I want to go back. I meant to bring this up, but we got kind of sidetracked a minute there ago, and you said that you have to be 62 or older, but another new rule change was you don't both have to be 62 or older.
Great point. Some of the really negative articles out there, I'll have a client, or sometimes their advisor or their children will say, well, I read that Grandpa lost the house. He got foreclosed on. He lost the house. Or Grandma lost the house. Well, what was happening up until 2014, if you had a married couple, if you were married, both of you did need to be age 62. Well, what was happening with some lenders, if you had a gentleman say he's 64 and his wife was 59, they would remove her from title and do the loan in his name. And he passed away, and now the loan's due.
Yeah.
She's forced to sell.
Right.
That was a problem. Those were horror stories. That is no longer part of the reverse mortgage. Now, if you're a married couple, only one of you have to be age 62 or older. And the younger borrower is eligible. It's called an eligible non-borrowing spouse. So if their older spouse passes away, the younger male or female, their spouse, can live in that house the rest of his or her life. That's a big change.
Yeah, certainly, because that's how in any reverse mortgage situation you want it to be, that no one is forced out of that house. You live in the house till as long as both of you live. The last survivor, then when they die, then that reverse mortgage comes due, and how does that process go? When
both borrowers permanently vacate the house, so if you can sell your house at any time.
Yeah.
If you have a reverse mortgage on it, if you decide that you need to downsize or right size or sell the house, you can at any time to the open market like you traditionally would. So when the house is sold, the reverse mortgage is paid off. When you both pass away, the house, then the reverse mortgage becomes due. So the house typically passes to the heirs, the estate, and then the executor of the estate has up to a year to pay off the reverse mortgage.
Okay.
Part of the article that I quoted earlier by Forbes on March 10th, it goes into a lot of detail about repayment.
Yeah, what you need to know about repaying a reverse mortgage. Certainly Google that article in Forbes that was published on 3/10/2016.
That's correct. And so if the children are able to sell the house for more than what's owed, they walk away with that equity. But if we're upside down and the reverse mortgage balance is greater than the value of the house, this is a non-recourse loan. That's where the Federal Housing Authority comes in. There's mortgage insurance built into the transaction. So the borrowers nor their estate, you cannot owe more than the value of the house.
Jerry, I'm going to give out your phone number again, 670-4332. Jerry has copies of these articles that he's referenced today, and he can email to you. Or if you just like to talk to Jerry and ask him a few questions, you can call him this morning, 670-4332. Jerry, I know that this situation arises frequently now. We have people moving into the area. We have people right-sizing in retirement, moving out of that bigger home into something perhaps smaller or in a different location. Maybe they want to be next to the grandchildren or whatever. But what is this now that we're hearing a lot about using a reverse mortgage to purchase a new home?
Yes, this is exciting, especially here in the current market. Charleston has been discovered. I think every other tourist publication
we all
has
know
this
that
ranked
by the traffic.
Yeah, the traffic, and house values are increasing and new neighborhoods are popping up. The traditional use of the reverse mortgage, the traditional use is I'm in a house, I want to stay in my house, and I want to convert the equity into tax-free funds. Well, that was created back in 1988, 1989, like we've mentioned. Well, in 2009, we were allowed to start using the reverse mortgage to purchase homes. Traditionally speaking, there are two ways to buy a house. Pay cash. I'm retired. We sold the old family home in Ohio, and we're paying cash for a house in Mount Pleasant. So they fly down or they drive down to Mount Pleasant, and they've got $250,000 cash, and they want to live on the water. And they realize that,
oops,
yeah, you're not
going to a little bit more than that.
You're not going to find maybe that ideal house for retirement for $250,000. And the reason why they're paying cash is they don't want a mortgage payment.
Mm-hmm.
So what we're now able to do using the reverse mortgage to purchase is they take that $250,000 cash from the sale of their previous residence. They use that as the down payment. They borrow $250,000 from the reverse mortgage, so they buy a $500,000 home, and they have no monthly mortgage payment.
Mm-hmm.
And that's when they turn their head sideways. Sounds too good to be true. Well, it's a mortgage. Our fixed rate today is in the 4%, 4.5%. So interest is still accruing. The interest is paid on the back end, like we talked about earlier.
Mm-hmm.
But here's something that's important. If you don't want the interest to accrue, you can make payments on reverse mortgages.
On the interest only?
You can pay the interest only.
You can pay
principal.
Okay.
You can pay principal and interest, or guess what? You don't have to make any payments.
Right.
That's flexibility. That's a feature that is very important when it comes to using the reverse mortgage to purchase a house.
Right. So you start making a payment, and then you don't want to or don't need to anymore in the future. You can stop making the payment, and it wouldn't affect your credit score a bit, would it?
Not at all.
Yeah. Okay. All right, Jerry, when's it not a good idea to use a reverse mortgage?
If you're in a home you want to stay and you want or need the equity, but a really important part of your legacy is that you want to leave this house debt-free to the kids. Because a reverse mortgage is allowing you to convert that equity into liquid cash to spend down. So there's not going to be as much equity or maybe no equity left for the kids using a reverse mortgage. So if you really, if you can't sleep at night because there's a mortgage on the house, don't take out a reverse mortgage because you are going to be spending equity that would otherwise go to the kids. The other idea about converting equity into cash is sell the house. So you don't have to take out a mortgage. You can sell the house. So if you plan on selling your home in the next year or two, just wait and sell the house.
Okay. You can reach Jerry at 670-4332 or visit his website, jerryismyadvisor.com. Jerry, really quickly here, got a minute to finish up the show. What are the steps in getting a reverse mortgage?
Educate yourself. Call me. Complimentary consultations. You can talk to me over the phone. I can sit down at your home. You can come to my office, and we can run some numbers. Once you determine that the reverse mortgage is right for you, you make a call to get a third-party counseling certificate, which is a safety feature. You sign an application. We have the house appraised from start to finish. It's about 30 days. But to get started, call me, please, 843-670-4332, and we can talk about if this reverse mortgage is right for you.
Start your discovery process about a reverse mortgage today. Call Jerry. He'll walk you through an easy, simple way to learn about the reverse mortgage. Perhaps you've got a myth or misconception in your mind about that reverse mortgage that doesn't apply today. These are useful tools for retirement planning. Jerry, thanks for your time today.
Thank you.
All right. That's all we have today for Retire Right. Join us again next week when Shane Griffin will be back here in the studio. on 94.3 WSC FM and 94.3WSC.com.